here. Welcome to another live stream. Today we're going to talk about the economic crisis that we seem to be headed towards here in the second half of 2023. We're going to take a look at some charts, take a look at some recent stories and surveys in the news, and we'll also talk about what this crisis could mean for the price of gold and silver, because I think that it's going to be very significant. So let's get right into it. Also, by the way, if you're joining the chat, thank you so much. Appreciate everybody who tunes into these live streams. Please do smash that like button. And as we go through these stories today and look at some of these numbers, don't hesitate to put any questions or comments you have in the chat, anything you want me to go over, anything you'd like me to cover. I do my best to keep an eye on the chat as we go here. Sometimes I do get kind of caught on a rant, but I do my best to interact with everybody who watches these live streams. It's part of the fun, right? So here's a story from July 7th. This one is from Markets Insider about U.S. bankruptcies now at the highest level since 2010. Yeah, very significant. I mean, think about everything that has happened since 2010. This means that bankruptcies today are higher than in 2020. I mean, really, give yourself a moment to just think about what that means. So according to Epic Bankruptcy, there is a 68% jump from last year. 3,000 firms have filed for bankruptcy in the last 6 months. And data from S&P Global Market Intelligence shows that the first half U.S. corporate bankruptcies surged to the highest level since 2010. So the evidence that we are headed towards an economic crisis here in the second half of 2023, it continues to mount. It's not looking good, folks. Here's another story. This one is from back in June, but I thought it was also relevant and indicative of the type of economic conditions we're facing. This one from Bloomberg: global high yield default rate seen hitting 5% in 2024. That's from Moody's. Now, high yield debt, that would be like junk bonds, but 5% is a very high level. And according to this information from Moody's, now mind you, this is from back in June, so far in 2023, there have been 62 corporate defaults globally, and North America has the highest concentration, split between 41 in the US and 1 in Canada. So we're beginning to see the cracks really showing in this economy, and a lot of this has to do with debt. I mean, that really is the big problem here. It's a problem of massive debts and deficits, which we're going to get into here in just a moment. It's the fact that the Federal Reserve, they're hiking rates to combat inflation, which perhaps is necessary, but in an economy as leveraged as we are in this one, it's creating massive amounts of pain. And the Fed's not really doing anything to address the real underlying cause of the inflation, which is the runaway debts and deficits, the out-of-control fiscal policy in Washington. So we're going to get into all of that and the implications for the price of gold and silver here in just a moment. Remember, you can buy your gold and silver at sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. And right now, even for those of you who aren't new customers, I just wanted to draw your attention to this sale they're having on this 1 ounce Arger Horaeus Kind bar for $40 over spot, any quantity. Pretty nice deal. Kind of the big brother to this little 5-gram bar here. I'm sorry, a 10-gram bar. But that is quite a deal on gold. And I'll tell you, the price for gold and silver, I do think as a result of this economic crisis, it could actually head a little lower, the paper price at least. But I'm going to tell you why I am still stacking despite that fact. Because I think that that's one thing I hear a lot is, if we get a crisis, gold and silver are going to sell off and I'll just stack then. Well, you might not want to wait, and we'll get into why here shortly. First, I want to take a look at the real problem here. This is the real problem. It's the big problem. It's the problem no one really seems to want to talk about, except for the fact that, we got politicians telling us we just need more of this stuff. And I'm talking about the national debt. Look at that. Almost at $32.5 trillion. I mean, this is incredible. the pace at which this debt is just absolutely exploding. It was just about a month ago, I think, that we crossed the $32 trillion level, and now already $32.478 trillion in debt. It really is amazing the pace at which we are accumulating this debt now, the pace at which the Treasury is selling more and more of this debt into the market. It's just a phenomenal thing. I mean, you think about it. I think it took 205 years for the U.S. to accumulate the first $1 trillion in debt, and now it's like half a trillion every month. I mean, it's completely insane. But that is why we are headed towards this financial crisis, and more specifically than just the debt is the interest that the federal government is paying on the debt. I mean, this chart will just blow your mind. Look at this. Look at this. This is the interest. This is from the Fed, too, by the way. This is not, a conspiracy tinfoil hat website. This is the St. Louis Fed. This is the interest expenditures of the federal government. I mean, look at that chart. Absolutely incredible. Now, of course, this does go back to the 1950s, and this is not like an inflation-adjusted chart or anything. So sometimes it can be good to look at these things in the proper context, but I want to show you another chart surrounding federal interest costs. This one is from the Cato Institute. So this is a pretty interesting chart. This one is from an article they posted back in March. Federal interest costs 1790 to 2033. So this has some projections in it. And this is the chart, which is, this is pretty wild. It goes all the way back to 1790. And now you don't need to adjust this one for inflation because this just shows you interest cost as a percentage of GDP, so relative to the total size of the economy. And you can see we are projected as we go towards 2033 to be hitting all-time levels of interest costs as a percentage of GDP. It's set to surpass 3.5%. You can see never in the nation's history has the cost of servicing the debt been this significant relative to the overall size of the economy. Now, this is all very relevant to the price of gold and silver, and I'll tell you why, because ultimately this level of debt is going to have a massive effect on inflation. It's going to have a massive effect on what the Fed is forced to do, and it's kind of frightening. I'm not going to lie. I mean, you look at how out of control the debt and the spending has gotten, and it kind of makes you realize that there's probably just no way back from this cliff, especially considering the fact that we are doing nothing to rein in the spending. I mean, we're doubling down on these policies. I see a bunch of people commenting in the chat there. Someone said Economic Ninja was commenting on similar stuff. Yeah, I love Economic Ninja. Great channel over there. A lot of good YouTubers. You get much better information on YouTube, I'll tell you, regarding the economy than in the mainstream news. That is absolutely a fact. Lots of good YouTube channels out there. There's another document I want to draw your attention to here. This is the most recent Treasury statement. This is from May. And very interesting here. Look at this deficit. Just for the month of May, $240 billion. And then you can see the interest cost, the net interest cost, $61 billion. Compare that to Social Security, the biggest item on the agenda here for the Treasury from May. And I think that as we see rates continue to climb, you're going to see this net interest begin to bink, 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 go right up this chart. And pretty soon the net interest cost on the national debt is going to be the biggest expenditure of the federal government. And that when that happens, I think that's going to be a little bit of a watershed moment of sorts. That's going to be when a lot of people get their eyes open to just how serious this issue is. Now, of course, one of the effects of this rising debt is higher yields on the treasuries. So I want to pull up the 5-day chart here of the 10-year Treasury yield. You see, we saw a pretty big move up last week, and we saw some market turmoil when this spike started. Now today, it's coming back down a little bit, but still almost north of 4%. And if we zoom that chart out and we go to the we'll go to the 3-year chart here, you can see that it was back in October of 2022 that yields were this high, and you have to go back that far to find a time when yields were spiking up like this. But I think that this 10-year Treasury yield is going to be moving much, much higher. And that means that as you know, it's not just the 10-year, it's all of the US Treasuries are going to be moving up in their yield. And the reason for that is that there are just a lot of folks selling treasuries right now. You know, you have foreign countries around the world dumping U.S. debt. This is one number. I know I've pointed this out in recent videos, but it bears retelling. This is the U.S. debt held by foreign countries. You notice this is one of the few numbers, excuse me, on the debt clock that is actually declining. And that is because the biggest holders of U.S. treasuries out there, the biggest foreign holders, China, Japan, a number of these countries are selling them. I mean, Japan, even a U.S. ally, I think if you go back 1 year, they had something like $1.3 trillion worth of treasuries. Today, it's 1.1. And China, it's much the same story. You know, they've been dumping billions and billions of dollars of treasuries, but they still have about $1 trillion worth of U.S. treasuries that they control when you count Hong Kong. And, you know, they're probably going to dump those at some point. They're not just going to do this slow bleed. You know, as geopolitical problems around the world continue to run out of control, we are going to see them dumping more and more debt. You got the Fed with their quantitative tightening. They are dumping U.S. treasuries, and it's causing the yields to go up. And that means that as the Treasury rolls over their debt, it means that that interest cost on the U.S. debt is going to be absolutely skyrocketing. And it's not just the U.S. government. I mean, I just point that out because they are really the worst offender when it comes to debt, but it is across the economy. We have record high levels of debt in just about every sector. I mean, corporate debt, out of control. Student debt, out of control. Credit card debt, it's nearly $1 trillion in credit card debt here in the US, and the rates are climbing. So we have consumers coming under a tremendous amount of pressure because of the level of indebtedness. And as rates continue to hike, we are going to see more and more pain. I mean, we're going to see more bankruptcies, we are going to see more debt defaults, and it's only a matter of time until the next shoe drops, the next crisis. Now, Powell has told us that we've got 2 more rate hikes, at least. He said at least 2 more rate hikes before the end of 2023. And I think that there is some reason to believe what he is telling us here. I mean, the Fed, you know, they've told us that they are data dependent. We've got the CPI numbers for, excuse me, for June coming out later this week. And if those numbers are even the least bit higher than expectations in terms of inflation, if we see inflation ticking up, that is going to be another impetus for the Fed to hike more. And I think that they will continue hiking. I mean, what their motivation for that is, whether it's because they think it actually will help fight inflation, which, you know, it won't as long as we continue to run these massive deficits and this massive level of spending, or maybe it's because there's some kind of an orchestrated collapse here. I mean, I don't know. It's impossible to read Powell's mind and the minds of those, you know, bankers on the FOMC. But I do believe they're going to continue hiking, especially if we see, you know, the jobs reports to continue to come out hot, you know, as they say. I mean, I think those numbers are largely rigged. But we do definitely see inflation remaining high. Core CPI remains stubbornly high. For the May numbers, it was still above 5%. I'm going to go to the chat here because I've got a couple people saying things. What do you think of 40% Kennedys at 230 over spot? I know, sorry, I'm just kind of going on a tangent here, but I thought that was an interesting question. 40% halves, I'm not a big fan of. I'm just going to tell you right off the bat. I like 90% silver or pure. Of course, the old U.S. constitutional silver is 90% silver. You know, dimes, quarters, half dollars minted 1964 and earlier. I am a big fan of those. The 40% ones, though, I think, when are those minted? Let me know in the chat if you know. I think it's 65 through 69, maybe through 70. The Kennedy halves, I'm not as big a fan of those. I don't know. I mean, the low purity silver, if it's the only thing available, hey, why not, right? I mean, I have a few of them, but I wouldn't stack that stuff in mass. I think that when the time comes to sell, and there will be some time to sell our silver, you know, I know a lot of people say that I'm just kind of like a permabull, that sort of thing. But, you know, I just think silver's massively undervalued at today's prices. That's why I like stacking it. But I don't know. The 40%, I don't stack too much of that stuff. Anyway, so we've got, a looming economic crisis here in the US. We've got the bankruptcies at the highest level since 2010. And then, of course, when you look at the geopolitical environment against which this is occurring, it's significantly worse than when we've had previous financial crises. In 2008, what did we have? $8 trillion in debt, $9 trillion in debt. The Chinese were still net buyers of U.S. Treasuries. That kept a lid on Treasury yields. We did not have significant inflation, and the de-dollarization thing wasn't going on. But look at this headline. This is from 9 hours ago, published last night. A headline from Reuters: countries repatriating gold in wake of sanctions against Russia. Study finds. So, this is further evidence that the dollar is no longer nearly as trusted. Western institutions are no longer as trusted as we head into, this fourth turning kind of shakeup in the geopolitical environment. This was a survey that was conducted by Invesco. Is a survey of central banks and sovereign wealth funds. It was just published. And I want to go over some of the numbers from this. So there were 85 sovereign wealth funds and 57 central banks that took part in this annual Invesco Global Sovereign Asset Management Study. 85% of those surveyed believe that inflation will be higher in the coming decade than the last. Yeah, I would agree with that. That's going to be a serious problem moving forward, this inflation. And we're going to get into why here in just a moment, because it has to do with the Fed's reaction to this looming financial crisis. But also, remember, there were about $640 billion worth of Russian assets that were frozen as a result of those sanctions following their invasion of Ukraine. And this survey showed that 60% of respondents had made those sanctions, the sanctions had made gold more attractive, and 68% of the respondents are now keeping their gold reserves domestically. That's compared to 50% back in 2020. So not only are central banks stacking gold at the fastest rate on record, I mean, you can go back to the 1950s when they began keeping these records, and central banks in 2022 and so far in 2023, I mean, they were stacking this stuff, gold, at a record pace, fastest pace on record. And there's a reason why. It's because they want to get out of the dollar and they want to get into hard assets. One central bank that was quoted anonymously by this survey said, "We did have gold held in London, but now we've transferred it back to our own country to hold as a safe haven asset and to keep it safe." Yeah, and then Rod Ringo, that's Invesco's head of official institutions, he oversaw this report. He said that if it's my gold, then I want it in my country, has been the mantra that we have seen in the last year or so. And so, yeah, folks are getting into gold, central banks, not just folks, big money here. I got someone in the comments saying silver is rigged and it always will be, so no thanks, and it has no yield. Yeah, well, I mean, that's true. Silver has no yield. That is a fact. And, if we lived in a normal economy, one that wasn't being managed by central banks and central planners, and one in which, we weren't sort of like at the terminal phase of the dollar's reign as the world's reserve currency, then I would say, yeah, don't do silver, don't do gold. Invest in companies, invest in businesses. But we're at a different time in the economic cycle. Economies move in cycles, and we're in the winter right now. You want to hunker down, get into safe haven assets. And now, listen, I'm not telling you what to do. Okay, when I say you want to, I'm really telling you how I feel. None of this is financial advice. And if you want to stay away from silver because you don't think it has a yield, well, go hold some dollars in Treasury. You can get in short-term Treasuries like 5% right now. And it's not a bad idea to have other assets. I'm not saying go all in on silver, but silver and gold, they've been money for 5,000 years, something like that. Gold and silver coins have been the money for most of human history since like 600 BC, and before that they were just using the hack silver and little pieces of silver. So they're a safe haven against these potential crises. Now, Why do I say stack gold and silver in the event of an economic crisis? Don't you think that the gold price and the silver price could come under some pressure in the event of an economic crisis? And yeah, I that there is something to that, okay? And I'll say to that a few things. The first one is you still want to have some dry powder. I mean, going into the environment that we are, there's a lot of uncertainty. It's always a good idea to have some cash because we could see a sharp spike down in the price of the precious metals in the event of some kind of a calamitous deflationary event. Bank failures, bankruptcies, credit crisis. It's always possible that the baby gets thrown out with the bathwater and people could liquidate precious metals holdings. But the reason I'm not waiting to stack is because, for one thing, I mean, just look at what happened in March when we saw SVB and First Republic Bank, this banking crisis kicked off. What happened to the availability of precious metals? Sure, you could go buy SLV and GLD, but remember at SD Bullion, they had something like a 4-week lead time to send out orders. And I mean, that was pretty much the story across the board at all of the major online dealers. I know a lot of local coin shops had their inventories picked clean very quickly. You got to remember that most of the silver and gold that get traded out there are paper derivatives of the real thing. They're not real physical gold and silver. So you don't want to just be sitting on a giant pile of cash saying, well, when everything collapses, that's when I'll buy my gold and silver. And I mean, I get people in the comment section who say things like that. I don't know. To me, that's a massive risk. I'm going to still stack kind of dollar cost average, keep some dry powder, and if the price of gold and silver declines significantly in the event of some kind of an economic crisis, well, I'll be stacking a lot more at those low prices, and I'll be glad to have the opportunity because that's when silver and gold will be getting set up for a massive run higher. And the reason is simple. I mean, the reason is because if we get an economic crisis, if we get spiking yields on US Treasuries, the Fed is going to intervene in a massive way. I mean, just remember 2020. It wasn't that long ago that the Fed slashed interest rates to zero. They initiated a $700 billion QE program. Then we got QE to infinity. And the economic crisis, which is looming, as economic crises go, they tend to get worse and worse, right? You don't get like a small economic crisis, then a big one, then a small one. No, they tend to get worse and worse. Just look at 2001 and then look at 2008 and then look at 2020. I mean, the crises have gotten worse and then the responses also have gotten bigger and bigger. And next time around, when the Fed intervenes in a face of a completely collapsing U.S. economy, they're going to have to print absolutely enormous quantities of money. If we start seeing the yield on U.S. Treasuries spike up, they will intervene to keep them lower. How do they do that? Well, they buy Treasuries. They run the printing press and they monetize debt. They expand their balance sheet. And I expect them to do that in a very big way. I've got some folks in the chat there. Yes, it will, Larry. Look at Venezuela. There's a huge market for trading silver and gold there. Yeah, I've mentioned before, I've got some family in Venezuela who lived through that hyperinflation, and some of them had precious metals, and it really helped them to get by as their regional currency was devalued. Now, I will say this. In Venezuela, what happened was you had a hyperinflation, and then what everybody switched to, they weren't running around with gold and silver trading, bartering. They were using US dollars, but the folks I knew, what they did was they took their gold and silver, they converted it into US dollars because the gold and silver, of course, had held the purchasing power. And so they were able to convert it to US dollars and then use the dollars to buy things in the black market economy there. But the problem is that in the US, if the US dollar gets massively inflated away by some kind of a Fed intervention, running the printing presses to infinity, which is eventually what's going to happen here, what do they switch to using? What do they revert to? They can't revert to an alternative currency. So, they go back to gold and silver. I saw someone in the chat there said they use Bitcoin in Venezuela. Well, listen, nobody I know in Venezuela, I know a few people who live there, use Bitcoin. Nobody. A lot of times they don't have power and internet. So, using Bitcoin, I'm sure some people do because, if you have hyperinflation, folks are going to use whatever they can. And the Bolivar, is basically just worthless paper, although I think things are kind of getting a little more under control there. But yeah, it's kind of hard to use Bitcoin when you don't have electricity. And a lot of places there, they have Look, they have generators and a satellite dish. Trust me, they use it. Lars Larson says. Yeah, I don't. I mean, yes, I'm sure some people have generators and satellite dishes, but if you need a generator and a satellite dish to go buy your groceries, I mean, look, it's much easier to go say, "Hey, I've got 5 ounces of silver that you know is valuable. Will you take that?" And then you don't need any fancy electronic equipment. You don't need satellite uploads. You don't need any of that stuff. You just say, "Hey, we're going to trade like humans have traded for thousands of years. We'll just go ahead and trade with hard assets." And again, I'm sure someone uses Bitcoin down there, but the people I know personally who live down there all used precious metals, and they weren't stacking bullion. They had stuff like Rolexes and stuff. I remember one guy I knew had a gold Rolex, and he complained that when he went to sell it, he didn't get his money back. He just was able to sell it for its gold value. And he kind of tried, when I was discussing this with him, he said, "Well, this is a reason that gold is not a great way to hedge against inflation." I said, "No, it's an example of why Rolexes are not a great way to invest in gold. Like, just go buy yourself a bullion coin. Don't pay the enormous markup that you pay to get a Rolex, and you'd be much better off. For the price of that Rolex, you could have had 10 times the amount of gold probably." But the point is, they were using precious metals to get by in a hyperinflation. Now, I know I said I wanted to talk about what would happen to the gold and silver price, so I want to get into some specifics regarding that before we wrap this up. This is a chart which we've kind of looked at in the past, but it's an updated one. This is a cup and handle formation that is forming in the long-term chart of gold. And I'll try to hold this tablet here so you can kind of see everything. But this is an extremely bullish pattern for gold in the long term. And basically, when we get a breakout above $2,100 on this chart, a significant breakout, if we close above that, say on a weekly or a monthly chart, this chart right here indicates that there will be a massive run up in gold. If you actually want to get a price target from this, you can see the cup starts at around 2,000 there. Bottom is around 1,000. I believe the rule for a cup and handle pattern is that you want to take the distance between the top and the bottom, and then you add that to the handle. So that would mean that if this chart is valid, someone says this is not a cup and handle formation. Well, okay, I'm not a technical analyst, but it is. I mean, you can look up a cup and handle formation, and this is one. So I don't know. Maybe somebody out there's a better technical analyst than me. I'm not saying I'm an excellent technical analyst, but this is certainly a cup and handle formation if I've ever seen one. And the price target from this chart would be around $3,100 is where you would expect the gold price to wind up. Now, I mean, I don't have a silver, I'm sorry, I don't have a crystal ball. I don't have a silver ball either, just a lot of bars and rounds. Okay, Vlad. Well, I'll tune into your live stream next time and you can tell me what a real cup and handle formation is. But it is interesting that that chart indicates that we'd be getting to around $3,100 because if you take the gold previous all-time high, that's it hit around $850 in January of 1980, and you adjust that for inflation. Now, this is the Bureau of Labor Statistics inflation calculator. You can see that if you adjust the previous all-time high for gold using the CPI, you get a number around $3,300. So if we get a massive economic crisis, which, I mean, it appears that we are headed towards. Now, whether that'll happen in 2023 or not, I don't know. I mean, maybe this economy can stand a couple more quarter basis point rate hikes than I think. But I have a suspicion that if we get two more quarter basis point rate hikes in 2023, given all of the other things that are going on, we're going to see a spike in yields. We're going to see something break here. But we very well could be headed towards new all-time highs, and I'm talking about real all-time highs, not just nominal, and that would mean heading towards that $3,300 level. Now, what does that mean for silver? What does that mean for silver? Where would the price of silver be headed if gold was headed to $3,300? Well, one of the things we can look at is the gold to silver ratio, and back in 2011, that got down to almost 30. I don't think it got quite that low, but again, when you're talking about these numbers, nobody knows for sure where anything is headed. History often, rhymes, but it doesn't repeat, right? I know that's a paraphrasing of that saying, but I think that what we could end up seeing is the gold to silver ratio dropping in a bull market. And that would mean we'd get silver at least around $100. If gold heads to 3,300, we get a 30 to 1 gold to silver ratio. That gives you a silver price of around $100. And I think that that's a very conservative price target for this next leg up in the price of silver. Now, when will that happen? Could happen sometime in the relatively near future. If we get this crisis, I think we'll see a sharp turn down in the paper price of the precious metals. I'm not sure you'll be able to buy them at that lower price, though, because the physical metal may become unavailable and premiums may go through the roof. That's kind of what we've seen in previous economic crises, is you get the paper price selling off and the premiums exploding. That is why I am still stacking today. I'm just kind of playing the dollar cost average game. But I think that we could see silver head up to $100 when the Fed pivots. There's all this talk about the Fed pivoting. That's been the word ever since the Fed started their program of rate hikes. But when you look at how the economy is declining, we've got record high bankruptcies, we've got spiking Treasury yields, we've got the de-dollarization, and recently, you had Congress telling Janet Yellen to get ready for if the Chinese dump their U.S. Treasury holdings. What's that reaction going to be? Well, it's going to be the Fed coming in and buying up all those treasuries to prevent the yields from spiking. I've got some trolls in the chat, saying $100 for an ounce of silver. Ha ha ha. Yeah, well, if you take the previous all-time high for silver and you adjust that for inflation, I think it gets you closer to $200. Yeah, we can do that real quick. So in January of 1980, silver hit $50. So that gets you a price target of $195. Keep in mind, a lot of times one of the things I hear is that the Fed is hiking rates. That's going to be bad for gold and silver. Higher interest rates, bad for gold and silver. Well, in January 1980, when they hit their previous all-time highs, the still current all-time highs, that is right after Paul Volcker hiked up the federal funds rate to like 20%, just under 20%, 19%. And then we saw the price of the precious metals go very, very high indeed. Now, he did manage to get inflation under control by hiking rates that time around. But remember, back then we had about $1 trillion in debt here in the U.S. The debt to GDP ratio was drastically lower. Today we find ourselves in a much worse situation. Inflation is much worse. They do massage the numbers with the CPI, but core CPI is still very high. And the Fed, they haven't been nearly as aggressive as Volcker has been, because they know that if they do, the system's going to collapse. We've already got a banking crisis this year in 2023 that's worse than 2008. The total deposits of all the banks that have failed so far, worse than all the banks that failed in 2008. And we're only halfway through the year. And again, geopolitical risk, financial risk, massive amounts of leverage in this economy. Things are already starting to fall apart. And we're just getting started, folks. And so, hopefully cooler heads will prevail. Hopefully we'll balance the budget and, find a way out of this without a crisis. But I don't see it happening. If you ask me, that's not where we're headed. And you know what they say, hope for the best and prepare for the worst. So that's what I'm doing with stacking physical hard assets in my possession outside of this rigged financial system. Assets that can't just be printed away, that aren't dependent on the whim of a central banker. And even those central bankers, they like this stuff a lot. They're stacking up gold, but remember, they don't have any silver. That's why the silver remains my focus. I like gold and silver. I think they're both going to do well in this coming financial crisis, but I do think that silver is the more undervalued of the two and will show and demonstrate the bigger gains. I'll go to the chat real quick here before we wrap things up. Lars says chain analysis. I missed that chat. Sorry, I'm on my phone and things kind of fade in and out on the chat. I think he was saying that they're using Bitcoin in Venezuela. Well, possibly. I don't know. You know how I feel about Bitcoin if you've been watching this. It's kind of interesting. Okay, he repeats it. Chain analysis, a startup that researches blockchain transactions 2020 report ranked Venezuela as third on its global crypto adoption index, largely due to the high volume of Bolivar transactions. Yeah, well, that's interesting. That might also be a sign that if Venezuela, a place experiencing hyperinflation, is number three on that list, it could, who knows? I mean, it could just be a sign that not that many people are using Bitcoin. I don't. I've never bought anything with Bitcoin. I don't know anybody who's bought anything with Bitcoin. No, you know what? I did actually buy some silver with Bitcoin once. I had some Bitcoin and I purchased some, I think, from SD Bullion a while ago. Um, but really more for just the novelty of it. Yeah, maybe Bitcoin is a thing. I don't know. I mean, it's only been around for what, 10 years? A little more than that now. But it doesn't have the track record that gold and silver do. You require a fair level of technological sophistication to use Bitcoin. You know, like you said, you're going to need your generator and satellite to access your Bitcoin. I like gold and silver that I can hold them in my hand, and also you can use them for things, right? You can actually, make a cell phone with silver. You can make a electric vehicle. You can make a solar panel. Bitcoin, I don't know, maybe better than fiat, maybe not. We'll see. Anyway, that pretty much wraps it up today. Thank you all very much for tuning in. Stay safe, everybody. Let me know what you think in the comments down below about this potential for an economic crisis, because I do think this is a real problem. But I do appreciate everybody watching. Smash that like button. Don't forget to like, comment, and subscribe, everybody, and I will catch you next time. Smart Silver Stacker, out.